revised. This particular standard has been issued previously, but it is becoming effective now. So that is why we're dealing with that. It's becoming effective. Working papers have been drafted and, well, have been designed and issued and included in DraftWorks updates. So this is to refresh you on the theory. Then we'll have a next session dealing with practical case studies or examples to try to put the theory into practice for you. And then there will be another session dealing with the actual DraftWorks working papers so that you can pull everything together and see where everything should be documented and done during your audits. All right, this is just a quick slide on me, who I am. I've been a CA for roughly 20 years and a registered auditor, been in public and private sector, had a bit of auditing, financial reporting, regulatory experience, investigations, and I've done a lot of quality reviews. But I must say, I like the most presenting training and providing technical assistance. I am a bit of a bookworm, so I do enjoy this. So hopefully you enjoy the session. All right. So let's have a look at what's on our agenda for today. If you look at what are the key requirements of ISA 540 that this session deals with, it can be broken down into the following topics. Firstly, we start with risk assessment procedures, identifying and assessing risk of material misstatement, then your responses to the assessed risk of material misstatement, then disclosures, management bias, overall evaluation based on audit procedures performed, and written representations and communication with those charged with governance. All right, so those are the key topics, and that forms the framework of the standard and therefore also our discussion. I just want to highlight to you that there are a couple of very handy documents that the IAASB has issued when they issued ISA 540 revised. The first of these three documents is called the linkages, or the heading here is, it indicates the linkages between ISA 540 revised and other ISAs. Because remember, ISA 540 revised is the auditing of accounting estimates, but obviously there are certain steps that links to other standards. For example, the risk assessment procedures and identifying and assessing the risk of material misstatement is dealt with in ISA 350, links to ISA 315, the risk responses to ISA 330, the reporting to the 700s, and then there are links to ISA 580, management representations, and so forth. So this is a handy document just to show you how it links up. Then another handy document, which I really like, is it's pretty much a one-page summary of ISA 540 revised. It's a very handy document, which is drawn up in flowchart, well, as a flowchart, and it shows how the requirements in ISA 540 revised flows. So these key topics that I've listed in our agenda: risk assessment procedures, identifying and assessing the risk of material misstatement, responses to risks, disclosures, management bias, overall evaluation, and written representations, all of them are on the left-hand side, and then you can see here are the steps. And here on the right-hand side, you'll see in light green, there are documentation requirements listed there. So there are lines drawn. You see those dotted lines from the requirements here in the middle to where it links up to the documentation requirements. So it's really a handy summary. So if you need to quickly revise again on the standard, go to this flowchart first. It is very handy. You can find that on the IAASB website. Then the third document or flowchart that the IAASB issued was called the 3 testing approaches. And what it does is it provides an overview of the 3 testing approaches and the key requirements of the standard as it relates to these 3 testing approaches. Because the previous diagram that I showed you was it only includes the key requirements, but there's not enough space to include all of the details of the 3 testing approaches, because that's where the real detail lies and how do we test these accounting estimates during our audit. So that's why it merited a separate flow chart setting out all of the requirements there. And there you can see all 3 approaches. Obtaining audit evidence from events occurring up to the date of the, events occurring up to the date of the audit report. The second approach, testing how management made it by testing the actual model itself. And the third one, developing an auditor's point estimate or range of estimates. All right, so 3 very handy documents that can make your life simpler, especially when you need to just look up again, where am I and what are the key requirements again. All right. So it's something handy to have on your computer and have ready for ease of access. All right, so let's dig into the actual theory. Let's talk about what are the actual requirements underneath each of these headings. And for that, we start with planning, right? With that, we start with the risk assessment procedures and related activities. What are normally, just in terms of the normal standards, in terms of ISA 315, risk assessment procedures are usually obtaining that understanding of the entity of and its environment, including internal control, through inspection, observation, inquiries. All right. So those are typically, and analytical review procedures. So those are typically what you do during planning. But now when you have accounting estimates at the particular entity that you're auditing, you must obtain a proper understanding of the entity and its environment and the internal control as it relates to this particular accounting estimate. You need to obtain this understanding to the extent necessary to provide an appropriate basis for the identification and assessment of risk of material misstatement at financial statement level and assertion level. So you must basically get knowledge of the business as specifically pertaining to accounting estimates enough to support your risk assessment, to ensure that you identify all of the relevant risks linked to accounting estimates, and then also assess them appropriately, and which ultimately leads to the appropriate response in terms of these risks. All right, so when you do your risk assessment procedures, don't forget accounting estimates. Make sure that it supports your decisions and you gather enough information that you can do a proper risk identification and assessment process as part of your normal risk assessment process of the audit. Then, as we are doing this, ISA 540 revised specifically also requires that you don't only obtain a specific understanding of how the entity and its environment and its control relating to the estimates function and how it works, but you must also perform always a retrospective review. So what it pretty much says in paragraph 14 of the standard is the auditor must review the outcome of the previous accounting estimates, the previous years, or where applicable, their subsequent re-estimation, of course, to assist in identifying and assessing the risk of material misstatement in the current period. So what you're doing is you're having a look as part of planning and as part of your risk assessment procedures. You retrospectively having a look at, okay, so last year there were accounting estimates. Now we can see what the actuals were in the current period. How does that tie up with the estimates that was included in the financial statements in the prior year? And The reason why you're doing this retrospective review at this point is not trying to find prior period errors. I mean, if you or the previous auditor gathered sufficient appropriate audit evidence, they followed all the steps, and at that point in time, that estimate was acceptable or reasonable in terms of the standards, then it was appropriate. So, it's not, the purpose is not here to call into question judgments in the prior period, unless the auditor in the previous period did not consider all the relevant facts that were available at that point in time. Yes, then it can indicate a prior period error. But the purpose of this retrospective review here at planning stage is to try to identify and assess the risk of material misstatement in the current period. So trying to get a feel of how accurate last year's estimates were and what indication does that give me of how it would be this year and how accurate it would be this year, and therefore what are the risks and how do I assess it, how am I going to respond to that. All right, at this point in time, you also, as part of planning, need to consider if the team needs specialized skills or knowledge. So it might be that the auditor within the engagement team does not possess all of the necessary expertise or specialist skills to perform the risk assessment, or to perform the field work, or to conclude, make an overall evaluation, or the whole thing. But normally you would have a fair grasp on the overall process, but it would be specific areas. And you need to identify during the planning which areas you might need an expert or an individual with specialized skills. It might be that for this particular accounting estimate, you are okay and you don't need specialized skills or an expert. All right, but you can see that it's specifically, especially where it relates to accounting estimates, because remember, accounting estimates can become quite involved depending on the type of estimate, the type of entity, the type of transactions involved. So it might be necessary in some instances to involve such an expert or persons with specific skills in that particular area. But as you can see, it can vary throughout the audit which areas of the audit you might need that skills, and it varies from client to client. All right. So you can see that all of this formed part of the risk assessment procedures that builds up to the actual risk assessment. So you'd perform all of these procedures to identify risk so that you can get to gathering all of those risks together and assessing a risk of material misstatement. So that leads us to talking about the risk of material misstatement and the assessment thereof. Now, for accounting estimates, ISA 540 revised paragraph 16 very specifically requires that when you are performing, when you are identifying and assessing the risk of material misstatement relating to accounting estimates and their related disclosures, it's important that you separately assess inherent risk and control risk. And when you look into inherent risk assessment, specifically as it relates to accounting estimates, you must evaluate the degree of estimation uncertainty. That means the degree to which the accounting estimate is subject to estimation uncertainty. That means how, where do I have that in my notes? It indicates the susceptibility of the accounting estimate and related disclosures to an inherent lack of precision in its measurement. So that's what estimation uncertainty means. And so you must specifically evaluate the degree of estimation uncertainty, and you must specifically also assess the degree to which the selection and application of methods, assumptions, data, point estimates, and related disclosures are affected by the complexity and subjectivity and other inherent risk factors relating to the accounting estimate. So you can see now as part of inherent risk, you specifically consider estimation uncertainty, complexity, and subjectivity, and then any other factors that you might think of in addition to that. But these three terms, estimation uncertainty, complexity, and subjectivity, must be very specifically considered as part of your risk assessment. So clearly, your planning working papers must include your considerations of these three elements to show that you've considered all of this to build up to your assessment of inherent risk at financial statement level and at assertion level for this particular accounting estimate. Now, while you are performing this risk identification and assessment process, you must use the considerations on the previous slide here on inherent risk and control risk. You must assess that, and especially the estimation, uncertainty, complexity, and subjectivity, to lead you to your conclusion on which of the risks that you've identified are possibly significant risks. Remember that when you have identified a significant risk, you must obtain an understanding of the entity's controls, including control activities, particularly relevant to that risk. That's standard from ISA 315. That same principle remains, that if you've identified a risk as significant, you must obtain an understanding of controls surrounding that significant risk to see what would your approach be in terms of that? How does it impact your approach and your response to that significant risk? All right, so the same counts here for the auditing of accounting estimates. All right, so that leads us then to responding to the risk assessment, to the risks of material misstatement that we've identified. So it's important to think, what's my first line of response to any risk, whether it's accounting estimates or anything else? You would always start with, okay, how do my controls look like? What was my control risk assessment? Does it include an expectation that the controls are operating effectively or not? If at this point you can already say, I've assessed control risk, the controls are really poor or deficient at this particular entity, or it's simply not good enough, then you probably know your control risk is high and you do not have an expectation that the controls are going to operate effectively. Therefore, you're not going to follow a control testing or combined testing approach. So you're going to use a substantive approach alone. But there may be circumstances where you do, when you assess controls, when you look at your system descriptions, your design and implementation, that means your system descriptions and your walkthroughs, you might find circumstances where there is an expectation that the controls may be operating effectively. Then that would lead you to testing those controls, the operating effectiveness of controls. That means you're going to select a sample and test that control for the entire period. But what other circumstance? The same principle from ISA 315 pulls through here, is that there may sometimes be circumstances where substantive procedures alone simply cannot provide sufficient appropriate audit evidence at assertion level on its own. Then that's one of those exceptional circumstances where you must perform testing of controls in conjunction with your other testing. All right, but usually it's pretty clear cut. Most of the cases, the systems aren't that complex that you have that second option, but just remember that that is one of the possibilities. All right, but the point I think that you can see here that I'm trying to make is it is important that you always obtain an understanding of control. Do your system descriptions and walkthroughs. That you must always do, specifically as it relates to controls relating to accounting estimates. All right, so it must include that. It must cover that. Your standard system descriptions might not cover it. You must make sure that your system descriptions include the accounting estimates so that you can assess the controls surrounding that as well. And then determine your appropriate audit approach, whether it's control testing or not. All right, now, if, of course, you had a planned control reliance, if there is planned control reliance and you've identified significant risks, that's one of the circumstances where you must then perform tests of controls together with some of your others. But if you don't have, as in usually most of the cases in smaller entities, if you don't have planned control reliance, then you are going to perform a substantive approach. So if you only perform substantive procedures, which is probably the bulk of your most of your audit approaches, you must include test of details. It's important that you then include those tests of details that you can't only do analytical procedures, pretty much is what it says. You must do detailed checking, looking at contracts to corroborate terms or assumptions, recalculating, verify that mathematical accuracy of the model, agreeing those assumptions to contracts, to third-party published information. That's the type of thing that you do need to do. You need to go into enough detail when you're auditing accounting estimates. Remember, an estimate includes judgment. So where there's judgment involved, there's always a risk. And the more judgment is involved, the higher the risk is. And that's why when we're talking about significant risks, that's obviously where significant judgment is in all probability involved. And therefore, there's a bigger risk of material misstatement, and we need to go into more detail. Right, so let's move on. All right, now, what's important to note is, remember I showed you that separate document that the IAASB issued in terms of the 3 testing approaches. Now, you can see that so far the principles in ISA 540 revised are very similar principles to what you would do within any audit and in the risk assessment procedures and identification and assessment of risk and your overall formulating of your audit approach and your general responses. But then in addition to these more generic responses, the following 3 must be considered, the following 3 testing approaches. ISA 540 revised in paragraph 18 specifically says that the auditor's further audit procedures shall be responsive to the assessed risk of material misstatement at the assertion level, considering the reasons for the assessment given for those risks, and the auditor's further audit procedures shall include one or more of the following approaches. All right, so pretty much what the standard says is you must, however you respond to the risk of material misstatement when auditing accounting estimates, you must ensure that you use one or a combination of these testing approaches. All right, so you need to understand each of these approaches. The 3 approaches are, firstly, you can obtain evidence from events occurring up to the date of the audit report. The second approach is testing how management made the estimate and the data on which it is based. So you go and you reperform, you really test the data assumptions and recalculate, you test the model. And the third approach is developing your own point estimate or range of estimates. All right. Now, there really can be various circumstances where more than one of these approaches, a combination of them might be better than just one, but it depends on the circumstances. There are cases where only one of these testing approaches are totally appropriate, but you have to assess based on the information, based on your understanding of the estimate, what would be the most appropriate approach. It's just very important that you do not pick an approach biased towards obtaining audit evidence that may be corroborative or towards excluding evidence that may be contradictory. So you can't try to see which one will have the most favorable outcome for the client. That's not how you pick an approach. You pick an approach based on how the estimate is done and based on the circumstances, what would be the most appropriate way to test whether the accounting estimate is reasonable. All right. Now, let's just look at a couple of examples on each of these testing approaches to give you an indication when each of these approaches or combination with some of the others would be appropriate. All right, so looking at approach 1, evidence from events occurring up to the date of the audit report would be most appropriate when events are expected to occur. And so when you expect certain events to occur after the balance sheet date, the date the estimate was made, up to the date of the audit report, so that there would be evidence available to support or contradict the estimate made at year end. All right. And there is, like I said, there would be evidence available to confirm or contradict. All right. So examples of such estimates where this approach could be appropriate would be revenue from contracts recognized at the stage of completion, receipts from debtors after year end. That one sounds fairly logical, right? Where you also look at net realizable value of inventory to confirm or contradict that net realizable value estimate. But it's very unlikely that this particular approach would be appropriate when events or conditions develop over a long period of time. For example, the provision for rehabilitation of a site, for example, or fair value estimates, because that would not be reflecting events and conditions at the balance sheet date, because it's now subsequent to balance sheet date that you're looking at. So evidence after that. So it's not at the right period. All right, so you can see that these are possible examples, and that's the circumstances where it probably would be most appropriate. Looking at approach number 2, to test how management made the estimate and the data that they used, it would be appropriate when it's developed on a model with observable and, generally observable, preferably. There can also be unobservable inputs, but it's a model, it's a system that they use. The estimates made in the prior year suggests that in the current year, the process would be likely to be effective. And the estimate is derived from routine data processing by the accounting system. It's based on large populations of similar items that are not significant. So you can see that it's large populations, a specific model is used. It can many times be very complex. Not always, you can sometimes have simple models as well. But those are typical examples. So looking at practical examples, if you look at a fair value estimate developed on a model, that would be an appropriate place. Share-based payments, that could be an appropriate place to apply this particular approach. When we get to approach number 3, development of point estimates or range of estimates, this is where it's the estimate is not derived from routine data processing as it was with approach number 2. Okay, so similar estimates in the prior year suggest that the current year process is not necessarily likely going to be effective. All right, so a similar system will not necessarily work. Then you have to use the facts and circumstances and develop a point estimate for this particular year. It will also be more appropriate where, for example, controls over the process is not well designed, implemented, and maintained. So you can see that the testing the system in the previous approach would be more appropriate where there is a system where controls are working, a homogeneous a population of transactions, where here you're looking at things that are not the same year on year. For example, also where management's point estimate is contradicted by subsequent events. That's probably where you have to develop your own point estimate. But it is important that alternative relevant data sources should then be available to the auditor to develop their own point estimate or range of estimates. Examples of these type of estimates would include the assessment of useful lives and residual values of PPE and impairment of goodwill. All right. Just lastly, when we think of formulating our responses to the assessed risk of material waste statement, that means things that we need to consider during fieldwork testing of these accounting estimates. You need to remember that you must still comply with all the relevant requirements of ISA 500, considering and documenting your audit evidence. What at least I can say is when a management expert is used, certain requirements of ISO 540 revised may assist the auditor in evaluating the appropriateness of the expert's work. So the requirements of this standard can already help you to get to the point of meeting the requirements of ISO 620 in terms of using the work of experts. ISA 402 service organizations can also help you and can work nicely together with auditing accounting estimates in terms of this standard. All right, so these are just a couple of considerations as you think of fieldwork. Then we're not really done with fieldwork yet until we've tested disclosures. This is an area where auditors tend to forget or fall down. And it's very important that we do not forget that there are specific disclosures in terms of ISA 540 that we need to consider when we are testing and auditing these accounting estimates. It's important to obtain sufficient appropriate audit evidence about disclosures relating to estimates to address the risk at a certain level, not only those relating to estimation uncertainty, but in addition to that. All right, because if you read the standard ISA 540 revised, it's already important that in terms of paragraphs 26B and 29B, specifically where it relates to an auditor's point estimate or range of estimates. That is usually determined when there's quite a level of estimation uncertainty relating to an accounting estimate. And when you're using that auditor's point estimate or range of estimates to test that estimate, there are specific disclosures that must be made in terms of the financial reporting framework relating to estimation uncertainty. But in addition to that, management may make further disclosures other than just that estimation uncertainty disclosures. And then it's important that we as auditors make sure that we obtain that sufficient appropriate evidence about these additional disclosures as well. Obviously, you need to consider the requirements of the financial reporting framework, and you must make sure that these disclosures still achieve fair presentation, that it's not misleading, whether maybe more information need to be disclosed in addition to what's required in terms of the reporting framework. All right, so it's important you can see that you need to stop and spend some time on considering whether disclosures are appropriate. And that it doesn't only, where there are disclosures made beyond the estimation uncertainty, you need to make sure that you gather enough evidence about it and that you are happy that ultimately the disclosures are appropriate in the financial statements. And now, as we're going through this whole process, actually from planning throughout fieldwork And ultimately, in concluding and reporting, you need to consider and evaluate whether there are any possible indicators of management bias. It's important to evaluate whether judgments and decisions made by management in making these accounting estimates included in the financial statements, even if they are individually reasonable, are indicators of possible management bias. All right. So when indicators of possible management bias are identified, the auditor must evaluate the implications for the audit. If there are possible, if there is an intention to mislead, then the management bias is fraudulent in nature. So you can see that why it's important to consider whether there are possible indicators of management bias involved in this accounting estimate. So when you are obtaining your understanding of the entity of the accounting estimate and controls, you need to understand how do they make that estimate. How big is the risk of estimation uncertainty, complexity, subjectivity. Especially subjectivity is where you must determine how subjective is this estimate, and therefore how likely is it that there could be management bias involved. So if you think about the 3 testing approaches, if you look at events, they made an estimate, and you look at events up to the date of the audit report to provide you further evidence on the estimate made at year end, there can be management bias involved in the estimate. So there's a possibility. If there is a very specific model used and the data used, the assumptions used, the methods used are per a very specific model, and there aren't significant judgments involved in using that model. It's just a matter of inputting the right data, and filtering it through to the model, maybe there can be less amount of management bias involved. But especially where there's a big, a high risk of measurement uncertainty, then surely there's probably a higher risk of management bias. And you can see that it's important that we consider this because it links up to the risk of fraud. All right. So it's critical that we consider whether management bias is involved, because it may up our risk. It might, if there's management bias involved, I would make it a significant risk relating to that particular area, and make sure that my responses, my field work, my approach, my testing approach specifically responds to this risk of management bias, so that we can pick up whether there was actual bias involved in the process or not, or whether the judgments made are actually appropriate and based on facts rather than just thumb sucking or influencing it in the way that management makes it look as favorable as possible for the entity under the circumstances, instead of purely based on facts. And when we're concluding, we're obviously pulling it all together and seeing whether it indicates that there was possible management bias involved. It continually revolves around the risk of fraud. Okay, I think I've said enough about that. Now, once you've gone through all these planning and fieldwork procedures, you ultimately get to concluding and pulling everything together. And here, you need to evaluate. You need to perform an overall evaluation to see, firstly, whether the risk assessment done at planning was appropriate. So you need to look at all of the facts, all of the results of the testing, all of the outcomes to see, okay, were these estimates actually accurate? Does it, or reasonable? Does it point towards that we assess the risk correctly at planning stage? Or do we need to amend our risk assessment and do further work to respond possibly to an increased risk of material misstatement. All right, so it's important that you ask that question. Don't ignore it just because you don't feel like testing additional work. It's critical that you assess this, because remember, accounting estimates include judgments made. So it's critical that you spend enough time on that and gather enough evidence that you're comfortable with the judgments made and that it's reasonable. Okay, then you need to evaluate whether management's decisions relating to recognition, measurement, presentation, and disclosure in the financial statements are compliant with the financial reporting framework. All right, that it actually complies with the accounting requirements in terms of the accounting standards, whether it's IFRS or IFRS for SMEs. Then, thirdly, you need to conclude and evaluate whether you have gathered enough evidence, whether you have sufficient appropriate audit evidence to be able to conclude on this. You can see that this goes hand in hand with your reassessment of risk. And obviously, if you're unable to obtain sufficient appropriate audit evidence, it would have repercussions. Then you need to evaluate what's the implications for the audit. What's the implications for the audit opinion? Does it possibly involve a limitation on scope? Or what is the case here? It might include steps like that if you cannot get enough evidence to support the judgments made. Then, after you've gone through all those steps, which are all important, you must pull it together and determine whether the accounting estimates and related disclosures are in fact reasonable in the context of the financial reporting framework, or whether they are misstated. All right, so you conclude here, look at the actual numbers, and you need to make an assessment to determine, is it misstatement, yay or nay? All right. And it's very important whether you use a fair presentation framework or a compliance framework, you must ultimately be able now to conclude, are the disclosures included in the financial statements, are all the disclosures made that are necessary to achieve fair presentation. All right, so that is where, for example, it leads to my discussion earlier on if testing the disclosures in addition to those relating to estimation uncertainty, because sometimes they are to ensure fair presentation and that the financial statements are not misleading where it links to accounting estimates. It's important sometimes to make certain additional disclosures. And here you must therefore assess overall whether you're happy with the numbers and whether you're happy with the disclosures ultimately, that you are comfortable that the estimates are reasonable and that it's disclosed appropriately, and that the correct picture is given in the financial statements of these accounting estimates. All right, so it's critical that you consider all of those things to build up to this conclusion in your overall evaluation of the accounting estimates. Okay, and as you are pulling everything together, it's important to note that you must, as part of your existing management representation letter, or even if you want in a separate management representation letter, you must get written representation from management, and where appropriate, those charged with governance, about whether the methods, significant assumptions, and the data used in making the accounting estimates and the related disclosures are appropriate to achieve recognition, measurement, or disclosure that's in accordance with the financial reporting framework, and which are reasonable. All right. So it's important that first one that we list here on the slide, that the methods, significant assumptions, and data used in making the accounting estimates are appropriate to achieve compliance with the financial reporting framework in terms of recognition, measurement, and disclosure. That's a specific requirement. But now the optional is, depending on the circumstances, you may decide you might need additional representations about specific accounting estimates. So you must, as a minimum, at least have the general written representation or management representation letter on accounting estimates on these particular matters required by ISA 540 paragraph 37. But you can, if you feel a specific estimate is very special and there are particular matters that needs further representation or confirmation by management, then you request that additional separate management representation letter. All right. Now, once you've made all your conclusions and you've drawn everything together, it's important that you don't forget about communicating with those charged with governance. So when you see the link between ISA 540 and ISA 260 and 265, which talks about communication with those charged with governance, it's important to communicate, and specifically to communicate with these people, and it's important to communicate about significant qualitative aspects of the entity's accounting practices and significant deficiencies in internal control. So you must consider which matters then in addition to these to communicate. So you must communicate significant control deficiencies and any significant qualitative aspects of the entity's accounting practices as it relates to accounting estimates. But you might, based on your considerations and the circumstances, decide to also communicate regarding accounting estimates, and then it might include reasons, for example, given to the risk of material misstatement relating to estimation uncertainty, the effects of complexity, subjectivity, or other inherent risk factors in making accounting estimates and related disclosures. So you can see that there might be various aspects relating to making these accounting estimates and possibly, the practices behind it, and then ultimately control deficiencies, significant control deficiencies. There are a number of things that you may need to communicate. Of course, if you think about communication, it might be that you pick up on a non-compliance aspect, and then it might lead to reportable irregularity, something like that, where you need to communicate certain matters with other relevant parties, such as regulators or prudential supervisors. So don't think that accounting estimates are excluded from those type of considerations. It's all part and parcel of what you need to cover here. All right, and all of this gets pulled together ultimately in the documentation. So it's critical. You can see that the documentation, when we talk about documentation, we again follow through all of these basic steps. You need to document your key elements of understanding the entity, its environment, and internal control relating to estimates. You must document a clear linkage between your identified and assessed risk of material misstatement and your audit response. So your audit approach, your fieldwork testing. There must be a clear link between what you've identified and assessed as risks and what you've actually done in testing that accounting estimate. Then you must make sure that you document your response when management has not taken appropriate steps regarding estimation uncertainty. Because remember, where there's estimation uncertainty involved, management surely is responsible to take enough steps to ensure that they come to the right estimate. So they must work in controls, they must follow, they must develop a module, or they must consider what steps would be appropriate to address that risk of estimation uncertainty. It's not only the auditor's responsibility to consider that, management must consider it first. And then you must document what your response is based on what management did in terms of the risk of estimation uncertainty. Then you also need to document any indicators of possible management bias. Remember, I spent quite a few minutes on talking about management bias and the possibility, and that link to the risk of fraud. So it's important that you document your consideration of whether there are indicators of possible management bias, and if there are any, what is your evaluation of the implications for the audit approach, audit reporting, etc. And then you must also document significant judgments in determining whether the estimates are in fact reasonable in context of the financial reporting framework. Okay, the estimates and the related disclosures. And remember, when we document significant judgments, do we only document the conclusion? No, we must document the whole thought process building up to your conclusion. So when you think of accounting estimates, clearly there's a lot of judgments involved. And for each and every judgment involved from your side, you must evaluate whether management's judgments are appropriate, but you must say why you believe it is appropriate or why it isn't appropriate. So you must document your thought process behind your significant judgments in determining whether these estimates are reasonable, yay or nay, and whether the disclosures are reasonable, yay or nay. And when you're documenting, you must never forget that the principles of ISA 230 are also applicable here. That means documenting your work in a reperformable manner, addressing nature, timing, and extent of work performed, documenting, identifying detail, documenting what assumptions, methods, data, etc. you used, whatever is appropriate, of course, based on the testing approach that you followed. But those basic principles of documentation is always applicable, and also applicable here to auditing of accounting estimates. All right, so you can see how this pulls together into altogether into the audit working papers. You obviously need to have a planning working paper, or in your planning working papers, you need to have a specific working paper addressing the requirements of auditing of accounting estimates. So you need to have specific considerations. You can see that ISA 540 revised is much more detailed and specific as when compared to the previous version of the standard. And there are very specific things that you need to consider. So the working papers need to guide you and lead you in terms of that. So there would be, if you follow the DraftWorks methodology, there is a separate working paper in planning dealing with all of the planning related aspects, all of the risk assessment procedures, all of these specific considerations building up to the risk assessment. Then you've got your risk assessment. Then there's specific working papers that you follow when you audit, when you test, when you do the field work testing of these accounting estimates. And then there's specific separate document when you evaluate, when you conclude and report and evaluate estimates. All right, so that is just an important point that I wanted to note, and that's what will be dealt with in one of the following sessions. So please make sure that you attend that to see exactly how the DraftWorks methodology addresses that. I'm now going to stop screen sharing to see whether what are the questions. All right, I see that there was a comment. So approach 2, that means testing the model, you know, the testing the how management did the estimate and the assumptions and the data used. So that approach could also apply on IFRS 9 models to determine the expected credit losses. Yes, it can be a possibility. Yes, that approach can definitely be applied on those IFRS 9 models to determine expected credit losses. Yes, so that's an accurate comment. Oh, okay. I can see there was also somebody that specifically asked to send the slides. All right. That will be totally possible. Let's see if there are any others. Okay. I don't see any other particular questions. Anybody else that would like to make a comment or ask a question? I don't want to end the session prematurely. So I just wanted to make sure that I've addressed all of the questions. All right.